Tax News You Can Use, where we take complex tax issues and provide quarterly updates and tips to help you and your business succeed. I'm your host, Mariana Moghadam, tax partner at SobelCo, and this is Doug Finkle, tax director at our firm. Today, we have some great topics to go over. Before we start, we want to welcome you to our new pod series. So, Doug, there has been a lot of fluctuation in the price of gas in 2022. Is IRS doing anything with the standard mileage rate to help people?
Sure. So the IRS publishes these standard mileage rates every so often for the cost of taxpayers either operating an automobile for the purpose of business, charity, moving, or for medical expenses. So for 2021 and 2022, at the beginning of the year, the standard mileage rate was 58.5 cents per mile. And then the IRS did something unusual, which they usually don't do, is mid-year they changed the standard mileage rate because of the things that you mentioned, the increased cost of gas is to 62.5 cents per mile. So from July 1st of 2022 until December 31st of 2022, the standard mileage rate will be 62.5 cents for this year. And the taxpayer can take the standard mileage rate and compare them to their actual business's expenses of the use of their auto for business, and they can take whatever benefits them further. So yes, the IRS is aware that the cost of gas is causing excess expenses for the taxpayers in the use of their autos.
Right. So the increase is in effect for the last 6 months of the year.
Correct.
Okay. And how about meals and entertainment? There were a lot of talks about it. They were at one point they were excluded, then it was 50%. So what is the update for 2021 and 22?
So normally the exclusion for meals is that you're only allowed deduction for 50% of your meals. But because of COVID-19 and the fact that the restaurant industry was probably affected more than anybody else, they wanted to give that industry a boost. So for 2021 and 2022, they allowed 100% deduction of your business meals, but the one caveat is they had to take place at a restaurant because that was the whole objective behind it. It's set to expire in 2022, so unless it's reinstated, 2022 will be the last year you can take 100% deduction on your business meals, and then in 2023 it will return to a 50% limitation on the deduction of your business meals.
Are there any conditions in how you can deduct it, or do you need to meet any qualification?
Sure. One of the qualifications is the owner or the employee must be present when the meal is provided. 2, it must take place at a restaurant. So any meals at a convenience store, prepackaged goods, things like that are not going to qualify for the deduction. And in addition to the meal, tips can also be included in your 100% deduction.
So I guess they're doing this to make the business for restaurants improve because of what happened with COVID. Nobody was going out and eating. They're putting all these restrictions, so people actually go to the restaurants.
That's correct. It was to incentivize people to go to restaurants more and eat out.
Good. What's going on with research and experimental costs? Can they be expensed, or do we need to capitalize it and amortize it over years? What is the final change on that?
So a little known provision of the Tax Cuts and Jobs Act, which was in 2018, is in order to make the budget work. My understanding is they changed the rules starting in 2022 for your deductibility of research and experimental expenditures. Prior to 2022, you could either expense your research expenses, or you could amortize them over a period of not less than 60 months. Starting 2022, you can no longer currently deduct your research expenses. They must be amortized over a period of 60 months. So basically over 5 years, and that's your only option. And the other thing that it's going to affect is that there was a revenue procedure called RevProc 2000-50 that gave a taxpayer a number of choices in how they could deduct their software expenses that were similar to R&D expenses. They said that you could either deduct them currently, you could amortize them over a period of not less than 60 months, or you could depreciate them over a period of 36 months. So with this change, for software expenditures that are like R&D expenses, now the only option available to them is to amortize those expenses over a 5-year period. So there'll be a lot of changes in the research and development, expensing.
Mhm. So that would be effective 2022.
Yeah, it's
Okay.
this
Just
year.
wanted to read that.
Yep. 2022 is current.
So a lot of people are talking about the virtual currency and Bitcoin and all the virtual currency that we have. There should be some tax ramification about that on how to treat it, how we're going to report it for tax purposes. Has IRS set any regulation on that? Is there anywhere on the tax forms that need to be checked?
Sure. So starting, the government's starting to get very involved in, knowing about transactions in virtual currency. For 2021 on the Form 1040, which is an individual's filing return, there is a checkbox and a question to ask the taxpayer if they sold any virtual currency, and you either check yes or no. Starting in after 2023, virtual currency transactions will be required to be reported on a 1099-B, similar to any other type of sale transaction, like your capital gains are normally reported. And in addition, we're starting to see more companies use virtual currency. We've recently seen some companies starting to allow their 401k recipients to invest in virtual currency. So I think virtual currency is here to stay, and the government is learning more about it and wants to track it more because more people are utilizing it.
Yeah, actually an interesting concept that we do work with a lot of not-for-profit organizations, and we were asked if people can donate virtual currency like they donate their appreciated stocks. So virtual currency is treated as a long-term, as a capital asset. So IRS has confirmed that if you have appreciated virtual currency, you can donate that to a not-for-profit organization and be able to deduct the fair market value of that currency at the time you donate it to charity. So you get the deduction, you don't pick up the capital gain, and the not-for-profit organization actually gets a huge benefit from that. So keep that in mind when you want to be charitable.
Yes, I said the IRS is encouraging charitable giving.
Yeah. Another concept that IRS was doing to stimulate the economy was use of bonus depreciation, which you could write off a percentage of your capital improvement or fixed asset that you purchase that needs to be capitalized when you purchase it. So that concept is called bonus depreciation, and throughout the years since 2001, I think it was, that you were able to deduct anywhere from 30% to 100% at a given time. What is that percentage now, and is it going to sunset, or is it still here, and what percentages are going to be in 2021 and going forward?
So bonus depreciation, as you said, the ability to deduct 100% of the asset in the initial year on most property, except for maybe real property improvements, is going to start phasing down. That's part of what was in place under the Tax Cuts and Jobs Act. In 2023, it's going to drop from 100% to 80%, and then it'll drop down an additional 20% every year until it's fully phased out in 2027. So some taxpayers might want to consider another provision that allows expensing of fixed assets, which is called Section 179, which allows up to $1 million of expense on pretty much similar items to what you could deduct for bonus depreciation. The only catch is that the Section 179 expense starts to phase out dollar for dollar after $2.5 million of investment, and you also have to be profitable. So if you have a loss, then your Section 179 expense will not be deductible in the current year, but will carry forward. But as bonus starts to phase down, you want to consider both options.
Yeah. So there are a lot of things to consider whether using 179 or using bonus depreciation. You should always contact your tax preparer before you make those decisions, because 179 has some consequences. For example, that $1 million limitation is at the partner level if it's a pass-through entity, and the tax preparer needs to be aware of all the partnerships that you or S corps that you are involved in, so right decision can be made.
Right, and also there are differences in how the states treat 179 expense and bonus depreciation. So, as you said, Mariana, you really have to evaluate both to see what is the most beneficial.
Exactly. So, what do we know about Build Back Better Act? Have they come to a conclusion on that, or it's still up in the air?
So Build Back Better had a lot of steam, toward the end of the year and earlier in the year, but they were unable to get it passed. So, and it would have been an overhaul of many tax changes. So there would have been a lot of tax planning that took place this year. Mm-hmm. But right now, I think it's not going anywhere, and it's sort of dead right now until somebody decides to revive it. So we'll stay tuned on that.
Yeah, there were a lot of changes that was going to happen, and unfortunately, it doesn't give us a lot of opportunity for planning, but everybody should stay tuned and listen to what's going on to be able to make the right decisions. What about the Secure Act 2.0?
Yeah, that also had some momentum a few months ago, and then they didn't get it through, so that's sort of on hold. That would have changed things on terms of retirement participants, and maybe increase the amount that you could contribute to your pension. So I think it was a good thing, taxpayer friendly, but we'll see if it builds up steam. Probably a lot of this stuff will build up steam maybe after the elections. We'll see what happens.
Yeah, usually, as we have seen and experienced in the past, on December 25th, they are going to come out with all these tax changes that the tax preparers and tax consultants have to scramble to get involved with their clients and do some planning. Were there any special rules in 2021 that no longer apply for 2022? Is there any planning that the taxpayers can do?
So there's a couple of things that were taxpayer friendly that will not be in place for 2022. One was individuals were allowed to deduct 100% of their charitable contributions. The normal limit is 60% of your adjusted gross income, so that is returned in 2022, absent legislation to extend it. In addition, it wasn't a huge benefit, but the ability to take an above the line deduction for charitable contributions for non-itemizers, which was $600 for married and $300 for single, is also not available for 2022. So there were a couple of taxpayer-friendly provisions that are not in place anymore.
Yeah, that was a good thing that they were able to deduct the $600 above the line.
Yeah.
What are the limits for 2022?
So for 2022, your limit on charitable contributions will be 60% of your AGI, and then that'll be the limit that's in place for 2022.
Yeah, and for after 2025, it's going to drop down to 50% of your AGI.
Correct. As you mentioned, and that'll be a conversation maybe in the podcast in the future, but a lot of provisions were set to expire under the Tax Cuts and Jobs Act that were sort of mirrored to a two-term presidency. So after 2024, you're going to see a lot of provisions from the Tax Cuts and Jobs Act expire. So be an interesting conversation over the next couple of years.
Yeah. There were a lot of talks about eliminating or reducing the annual gift tax exclusion. Where are we now with that, and what are the limitations on exclusion amounts for gift and estate tax?
So for 2021, the limit per donee was $15,000 on the annual exclusion. For 2022, it will be $16,000. For the lifetime gifting exclusion and estate exclusion, it was $11.7 million for 2021, and it's going to be $12,060,000 for 2022. And the reason for that is it was indexed, when it was put into law, it was meant to be indexed for inflation. But that will be another interesting subject after 2024, because the gift tax exclusion lifetime is supposed to go back down to somewhere, I think it was 1 million, or million to 3 million. So stay tuned on that as the provision set to expire.
Yeah. So there are a lot of still unknowns, but we'll keep you updated. We're going to change our focus now to state and local taxes and give you an update on that. As you know, with Tax Cuts and Jobs Act, the amount of state and local taxes that individuals could deduct as itemized deduction was limited to $10,000. So states came up with a solution to that, so the taxpayers would get a bigger benefit than $10,000. As you know, with the states like New Jersey and New York, the real estate taxes are high, the state tax rates are high, so $10,000 is not really a big amount. So what the states did was that the pass-through entities like partnerships and S corporations can pay the state taxes, and they can deduct that for federal tax purposes, so the individual shareholders or partners can benefit from that deduction. A lot of states have adopted that. So, Doug, can you tell us about the states that are following the pass-through entity tax and which states actually have that?
Probably about half the states have adopted some form of pass-through entity tax. And I'm proud to say that the managing member of our firm, Alan Sobel, was very instrumental in working with the New Jersey CPA Society and legislators in getting a pass-through entity tax election approved for New Jersey, which we now have. Mm-hmm. In addition to New Jersey, the major pass-through entity tax elections that we have seen for the more of the states that we follow in this area are New York has adopted it, Connecticut has adopted it, New Jersey, as I mentioned, has adopted it, and California has adopted it. Pennsylvania has pending legislation to adopt similar provisions. So a lot of states have adopted this new regime, and New York had recently passed legislation early in 2022 to make the deduction more robust. So now they have come up with a new type of pass-through entity tax for New York only residents, and New York City has also adopted a regime to create a pass-through entity tax, and they also have a provision for New York City only residents where they'll be able to deduct the tax based on their entire income, not just their New York or New York State source income or New York City source income. So many states are adopting it. It's a very taxpayer-friendly provision. As you mentioned, it gets around the $10,000 cap on state and local taxes that individuals face. And it gives the taxpayer the ability, because most of these regimes are elective, the ability to elect to pay the taxes at the entity level, as opposed at the individual level where they would be eliminated by the $10,000 state and local tax deduction. So expect more states to adopt it in the future. A lot of them have pending legislation, like Pennsylvania, and other states have pending legislation. So I think pass-through entity tax elections are here to stay.
That's great. That's great news. So what's going on in the international arena? 2021 was a huge year for pass-through entities like partnerships and S-corps. With the K2 and K3, there were a lot of confusion. Who needs to file? Who doesn't need to file? And a lot of pass-through entity tax returns, as you may be aware, they were put on extension, waiting for more clarification on how to finalize it. Where are we with the K2, K3, and what is happening?
So as you said, the K2, K3 was a major overhaul. It was to make international tax reporting more transparent for pass-through entities and to give the partners and shareholders of those entities more transparent information. And it did cause a lot of problems initially in the industry. They're very complex forms. There's a lot of reporting on it. There was a lot of confusion regarding, the international reporting. And they did do a small carve-out, so some taxpayers did not have to file K2 or 3. The small provision said that, if you didn't have any foreign partners, you didn't have any foreign source income, you didn't have any partner that you had knowledge that would need the foreign source reporting from K2, K3, or nobody requested it, then you were exempted from the K2, K3 reporting. But, most taxpayers, high net worth taxpayers, have some sort of need for the K2, K3. So right now, the way it's going is initially the electronic filing was not available for K2, K3. I believe now partnerships can file K2, K3 electronically, and I think we're still waiting on S Corp. So, as the summer progresses, we'll see more and more, maybe updates or changes to K2, K3. But as of now, nothing really that new.
So what kind of information does this 20-page K2, K3 provide? What is that?
Sure. I mean, I guess in international reporting, you name it, it's got it. So for your foreign tax credit reporting, which most taxpayers claim, for example, if they had foreign income tax on a broker statement for dividends they paid, that would be subject to K2, K3 reporting. Any foreign partnership reporting, which would be out of what we call Form 8865, would be on K2, K3. Any international reporting for corporations, both inbound and outbound, are on K2, K3. Your FDII deduction, what we call your FDII deduction, which is your foreign derived intangible tax deduction, is on K2, K3. Your GILTI reporting, which is your global low tax base intangible taxes, on K2, K3. So almost you name it, it's on the K2, K3 if it has an international aspect.
Yeah, so you normally see all these information as a footnote to the K1. So they try to standardize it. So there is all one place on the K1, attached to the K1, that will have all this information, and it's not going to be footnotes here and there on the K1.
Yeah, you're right. It does make it more uniform. In the past, when you were looking at your K1, whether you're a partner or a shareholder, the foreign information would be all over, in many different places on the footnotes to the partnership or S Corp return. So from that perspective, it should make it much easier for the users of that information.
More standardized, yeah. So final regulations related to foreign tax credits were issued in January of 2022. What did the final regulations include?
Yeah, so the final regulations are a very complex set of regulations. Most people are calling it the greatest overhaul to the foreign tax credit regime in the last 100 years. And what they basically deal with is taxes that you were able to take a foreign tax credit in the past on your U.S. return, you may not be able to take under the new law. So you might have to look at how your foreign tax credit was calculated, because they talk about things like you have to really get to know foreign law a little bit better. You have to know, was the foreign tax credit calculated, or the foreign income calculated on the basis of, U.S. tax, or is it under a reasonable method? And they also, put in there some, attribution standards to say that, your foreign income should be based on your activities, your situs, to determine your foreign tax, gross income.
So what type of guidance do these final regulations provide?
So the final regulations provided a 100 pages of guidance to make it very complex. I think the takeaway is you really need to look at how you're reporting your foreign tax credits in the past to determine what type, what your foreign source income is, and whether your taxes are credible. And they also put rules into place in terms of the timing of the foreign tax credit for both cash and accrual-based taxpayers. So you really need to dive into these regulations. You need to contact your tax advisors, because the international tax arena is very specialized, and you want to make sure you're doing it right.
Right. Have you seen any updates in the form of foreign tax credits related to Russia and Belarus?
Yeah, I know there's a number of provisions because of what's going on with the Russian-Ukraine situation to limit or eliminate any foreign tax credit to any Russian or Belarus foreign taxpayers.
Mm-hmm. Thank you, Doug. This was very informative. Is there anything else you want to add?
No, I think we covered a lot of topics. I was glad to be here and look forward to the next quarterly tax updates.
Great. So this wraps up this session of Tax News You Can Use. If you have any question, you can contact us. For any additional information, please visit our website at SobelCollc.com and stay tuned for the next quarterly update.